Larry Shover, Chief Investment Officer at SFG Alternatives, joins us live over there at the CME Group in Chicago. I've also got David Land on the desk. He's our guest host from CMC Markets. Larry, let's just start with you. We saw a large sell order from a macro fund on Monday. We're now hearing that the Saudis are going to exert some downward pressure. What happened to this QE3 sugar hit? Have we forgotten it already?
Well, I think we've gotten it already, but let's keep in mind, let's back up a little bit to Monday. There was a large sell order in oil, but I think the picture is much bigger than that. I mean, it's a classic case of demand destruction, where at a certain price, Americans generally are not going to be using as much oil as before, combined with the fact with our EIA inventory report came out much bigger than expected with crude oil reserves, and refinery production was up 4%. And lastly, we have Brent oil maintenance that's up and running once again. That's over, so we're going to have an oversupply of oil. It brought the price down. I mean, I don't think it had a lot to do with any kind of high-frequency trading or hedge fund order. It had something to do with it, but the fact is we had a classic case of demand destruction.
Okay, so down 7% this week. Are we likely to see an uptick pretty soon? Surely it can't stay down at these levels now.
No, I don't think it will. I mean, I do believe that we have WTI probably about $93 on average by the end of the year, and we'll see Brent about $17 to $20 higher than that. I mean, we're just having a little bit of a technical correction. It did break through some key support levels, and we're just seeing a little bit of just stop orders into the market. So I don't think we'll see it much lower than that. In fact, I do believe that we'll see it a little bit higher from now till the end of the year.
Larry, I noticed some of the currencies out there. The euro has been, I would say, you know, fairly weak following on from QE3. I mean, do you think there's sort of money that was placed into the market that's just being taken out on the back of quantitative easing, or alternatively, are we seeing such a race to the bottom in the currency markets that the US dollar is getting better supported than we may have otherwise seen?
Yeah, I think the latter is true. And actually, David, if you don't mind me saying, I mean, the big trade right now, or what's really churning right now in the U.S. is the quandary of the Australian dollar. I mean, we're seeing it at 104. I mean, we've seen commodity prices just take the leg out, thinking that a lot of people are thinking that the Australian dollar deserves to be around 90 or 95. But on the other hand, people don't realize that you guys still have a AAA rating. That's something not many people have. Your bond yields are very high still, so maybe there's some support there. So that seems to be the biggest trade right now. I think the risk premium to the euro, which you were saying, seemed to be to the downside, and so there was a snapback effect, and the euro did snap back up around 130. It seems to be a big resistance level. So at some point, I do believe we'll see the dollar remain stronger against the euro. The Aussie is anybody's guess. It's going to be a fascinating trade for the next couple of months. Yeah,
absolutely. I mean, we're seeing the central banks pile into the Australian dollar here at home, and certainly lots of debate surrounding that. What about risk currencies going forward? How do you see that playing out over the next 4 weeks or so?
Well, I mean, that's the thing that no one seems to know. When you look at like the Australian dollar, I don't view that as a risk currency, but definitely
not anymore,
the ultimate commodity currency. Not anymore, no. I'm talking about more of the missed currencies, whether it be Mexico, Indonesia, South Korea, or Turkey. If you want to talk about those currencies, well, you figure those countries combined now have the GDP the size of Germany, so there's a lot of room for improvement there. But people are trying to comb out and find out if there's going to be growth from those countries, if there's going to be continued demand from those countries. But I definitely would bet on those compared to the BRICS. And when it comes to other commodity currencies like Canada or Aussie, it's anybody's guess right now.
Here's something that is leveraged to global growth, and that's copper. It's been pretty resilient despite these terrible manufacturing reads we keep seeing come out globally. Why are we seeing this? Why is it proving so resilient?
Yeah, and it has, and as Aussies know more than anybody, when you compare copper to aluminum or stainless steel, nickel, steel, what have you, I mean, it's been frustratingly resilient all year, and even more now. And I think it's one of those old school conundrums where we used to think that things rallied because good economic conditions were right around the corner. Well, I think that's all changed, and now that we know that policy, or whether it be Fed easing or China infrastructure products, that's right around the corner. So therefore, you think that copper is going to be the main recipient of that. And let's keep something in mind. When it comes to infrastructure projects in China, copper is going to be about a 40% recipient of that, comparing that to steel, which would be 10 to 15%. So that's probably one of the main chief reasons why copper has been so resilient.
Okay, what about supply as well? Because we're hearing there's a lot of constraints there.
Oh, yeah. I mean, right now, supplies are basically 4 weeks over demand, and that's been a struggle. But that's been a struggle for the past couple of years, and we have seen inventories drawn down a little bit. At last look, we saw LME stocks at about 213,000 metric tons. At the COMEX, it's 50,000 tons. But of that, we just don't know where that's going, and it seems like a lot of that's continued to be tied up in collateral for financing. So downstream, it's been very, very hurtful for the Chinese. I mean, they have been patient as buyers. They're great copper traders, but right now there's no scrap generation to be had. And right now that you see the futures markets in contango, in a deep contango, you have the arbitrage negative to the Chinese, so they're actually really stuck. So even any type of recovery, any type of infrastructure project from the Chinese is going to cause an upward pressure in copper.
We also seem to be getting a bit of momentum back in the gold price. I mean, is this the time? I find, you know, a lot of the sort of gold bugs that you see around are probably still feeling a bit sad from buying at high 1900 an ounce. But, you know, is this the time where they're going to get their money back and see the push on to 2000 with the infinite QE?
Yeah, you think like finally conviction is back in gold. I mean, look, I mean, what a volatile range we've had all year. And basically, I think everybody thought that the world was going to continue to ease, but yet gold's stuck at like $1,550, $1,600 an ounce for months. And then we got this pop. I think it's one of those things where you buy the rumor and you buy the news, because I don't think people realized that the Fed was going to just keep the doors open to continued easing. And the more we ease, the more gold's going to go up. Now, what's going to keep a support on prices is that we have to worry about the Indian market, because it's become very, very expensive for them to buy gold. And the news is that they are going to be surpassing China with regards to their demand for gold price. But at this level, in rupee terms, it's very, very expensive. So I could definitely see gold going to $2,000 an ounce, but it would be a stretch for it to go any higher than that anytime soon.
We're seeing some good housing data coming out of the US as well, but I mean, it's so far off those pre-GFC highs. I mean, is this something, if it goes up far enough, people are going to start saying the Fed was right all along?
Yeah, David, I'm glad you asked that, because let's keep in mind in the U.S., we have fallen down a 7-year flight of steps in terms of housing prices. So, yeah, it is true. You're exactly right that the housing numbers have stabilized. They've gotten a little bit better. On one hand, I don't think we can underestimate the tailwind of a recovery in housing. But on the other hand, we do have to realize that right now it's really stabilizing. We've fallen down so far that I'm not sure that the trajectory is straight up. It might be more of a fact that we're stabilizing, and it might be a good place to get into the market. However, I don't think it's going to be ratcheting up too far anytime soon.
I mean, the broader effect, how do you play that US housing recovery then? What are you buying to get some kind of exposure to that?
Yeah, so in the U.S., people that want to get exposure are buying some of the big box retailers like the Home Depots, et cetera. And there's also housing ETFs that are maintained with housing stocks. If you want to get to a higher beta, people are getting involved in like Alcoa, one of my favorite stocks, and I think it's really out of favor, but probably a really good time to buy it if you do believe that there's going to be a tailwind in the housing sector.
Okay, we're going to have to leave it there, but Larry Shover, thank you so much. We do appreciate you joining us all the way from Chicago.
Yeah, you're welcome. Have a good day.